Hi everyone, and thank you for tuning into my channel where I talk about stocks, the stock market, and investing. I post videos daily, so if this sounds like something you want to get more of, feel free to subscribe. In today's video, I'm going to answer the question if DocuSign's stock is a buy. I'll be using my simplified 6-step framework, and towards the end of the video, you'll have an answer if DocuSign stock is a buy or not. Okay, so let's get right into it. The first step in my framework is the customer value. What is it that attracts customers, or what is it that convinces customers to go with DocuSign? And one reason is that it adds convenience to clients by removing all annoyances from physically signing documents. Think about DocuSign electronic signature signing. So you get an email, you open it up, read the document, click, sign, return, all done electronically. This removes the need to drive to a location, find parking, go up the stairs or the elevator, go into an office, sign the document, and then leave. So that removes that whole friction between that process. Another option would be for the company to send out an employee to your home to sit with you, to bring the documents, have you sign them, and then the staff leaves, or have them FedEx you the documents, you sign them, and then you have to return them through the mail or drive the documents back. All less efficient than the electronic signature that DocuSign provides. So it adds convenience, tremendous convenience. That's a big benefit. Secondly, it adds cost savings to enterprises by removing those staffing needs to support physical document signing. If you have to go to an office, then the enterprise needs to have someone that greets you, shows you the documents, walks you through the process, helps you sign them, and then spends the time with you to maybe explain, answer a few questions. That's all cost. That's a person that needs to be with you during that time. And so it removes that expense. Secondly, after those documents are signed, then the company needs somewhere to store those documents. So that's an expense to store and keep those documents on file. So it removes all of that. Good value proposition there. I like that convenience that DocuSign adds. The next step in my framework is the unit economics. So for DocuSign, there is each incremental customer adds little cost to their process. Think about when a client sends you an email to be signed electronically, that doesn't cost DocuSign all that much money. The technology that's being used, really. It's not going to cost DocuSign that much money. And so with each new customer, with each new use case, those incremental revenue, those incremental sales flow nicely to the bottom line. However, there is significant expense in developing the technology and acquiring customers. That's the big expense, is acquiring customers who hesitate going digital. Customers have skepticism about switching from physical document signing to going to digital. They worry about fraud and they worry about getting hacked and all of the customer privacy and those issues surrounding that. That's where the most cost is for DocuSign. It's not in the incremental cost from the customer signing document going back. So solid unit economics there, especially once they get to scale enough where electronic signature signing is more widely adopted and it's not as difficult to convince enterprises to come on board and switch to digital. The next step in my framework is the total addressable market. I like to invest in companies that have massive market opportunities. That way, when they're growing, they don't hit a ceiling and reach the limit of their market opportunity. For DocuSign, management estimates a $50 billion market opportunity, not a massive market for DocuSign. To put this figure into perspective, the advertising industry is worth roughly $800 billion. The travel industry is worth roughly $1.5 trillion. So, addressing a market opportunity of 50 billion, relatively small. The next step in my framework is competition. Adobe offers competing electronic signature services. That said, the industry is not battling each other. Instead, they're working towards reducing skepticism for digital signature adoption. So there's a lot of work being done to onboard enterprises that are skeptical of moving to digital. And the industry, advertising, salesmen, education, all of that technology is working towards bringing enterprises onto the digital signature signing market. So the service providers are not really competing against each other. They're working to bring more enterprises on board. So that's good news for investors that they're both working together, and their advertising and their salesmen, all of that is working towards expanding the market for digital signature solutions. Next step in my framework is valuation. And for DocuSign, the stock is inexpensive when measured by the price to free cash flow. I have here DocuSign's 5-year historical price to free cash flow average. Right now, it's trading at a price to free cash flow of 26 as of September 12, 11:42 a.m. Pacific time. And if you look back over the past 5 years, this is just about as cheaply as you've been able to buy DocuSign when measured by the price to free cash flow. The caveat here is that DocuSign's cash flows are decreasing year over year, and so this valuation may be misleading when you consider that cash flow is going to decrease over the next, if this cash flow decreasing year over year persists for the next few quarters. But looking at it just from face value, it's relatively inexpensive when measured by the price to free cash flow. All right, so now that we've considered each of the steps in my framework, I like to give it a grade, give each one of the steps a grade. And for the customer value, I gave DocuSign an A because it provided significant convenience advantages. For unit economics, I gave them a B because each incremental customer does not cost them very much money. However, the high acquisition costs and technology investments are leading to losses on the bottom line. So I gave them a B there. The total addressable market, they got a C plus score from me. It was a relatively small total addressable market. Competition, I gave them an A because competition in the industry is not battling for existing customers. It's working towards expanding the market, so I gave them an A there. And valuation, I gave them a B plus. Overall, when considering all of those figures together, I came up with the verdict recommending DocuSign stock as a buy. So DocuSign had its pluses and minuses, but overall, the inexpensive valuation and the long run tailwind from the fact that it is so much more convenient providing electronic signatures compared to legacy methods of physically signing the documents pushes it over the edge and makes it a buy for me. But let me know what you think in the comments down below. That's all I have for DocuSign today. Stay tuned for next time, and I'll see you then.
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular Stock Advisor. Stock Advisor has beat the market by more than 250%. Go to fool.com/Parkev to get your 10 stock picks now.